Welcome to AlphaCall, where we move beyond the numbers to decode what's really driving India's listed companies. Today, we are talking about Samhi Hotels, one of India's largest branded hotel owners and asset managers. And this quarter, the company didn't just report strong earnings, it marked the start of what CEO Ashish Jakhanwala calls it Samhi 2.0. So let's quickly look at the key financial highlights. Total income came in at 2,963 million, up 11% year on year. Consolidated EBITDA was 1,105 million, up 14.2% year over year, with margins expanding to 37.3%. Profit after tax came in at 998 million, a 6.9x jump driven partly by the reversal of a Navi Mumbai land impairment worth 696 million. Net debt came down to 13.7 billion from nearly 20 billion at FY25 end. Average cost of debt is now at 8.5% and trending lower after recent refinancing. Their credit rating got upgraded to A plus stable by CARE. So a strong quarter on paper. But the real interest is how this growth is being built. Yes, the inflection point. Jakhanwala opened the call, calling this quarter a clear inflection point for Samhi. After years of expansion through acquisitions, the company is now self-funding its next growth phase, generating enough free cash from operations to finance new projects without relying on heavy borrowing. What did the analysts focus on in the earnings call? So most of the analyst questions this time weren't about margins or RevPAR. They revolved around capital discipline, whether new projects in Navi Mumbai and Hyderabad could stretch the balance sheet again. CFO Rajat Mehra clarified that investable surplus is roughly 1,700 crores, and both projects are phased over 3 to 4 years and will be funded through internal accruals. So that line alone shifted the tone of the call. And after years of being seen as a leveraged platform, Samhi now wants to be known as a cash generating growth story. So, what about this Navi Mumbai bet? Yeah, this was the headline move. Samhi's first hotel in the Mumbai metropolitan region, a 700 room dual branded property under the Westin and Fairfield by Marriott names, located near the upcoming Navi Mumbai International Airport and DY Patil Stadium. Phase 1 alone, about 400 rooms, involves a 650 crore investment, including land and approvals, translating to roughly 1.7 crore per key, well below Mumbai's replacement cost, anyways. Now, here's the twist. Analysts asked why Navi Mumbai and how Samhi will manage such a massive project. Jakhanwala revealed that the land came as part of a prior acquisition, costing them only 26 crores, a fraction of current market rates. That low entry cost makes the economics highly attractive. But more importantly, this project fits into a macro theme Samhi has tracked for years: the shift of commercial activity from traditional city centers to new business districts. He compared Navi Mumbai today to what Gurugram and Whitefield were 15 years ago. Once peripheral, now prime. He said this project will redefine not just Navi Mumbai's skyline but also Samhi's next decade. So the expected full-scale EBITDA potential for this is roughly 180 crores annually, making it the company's largest single asset contributor once operational. What about the capital efficiency in their Hyderabad location? So if Mumbai was all about scale, Hyderabad is about capital discipline. Samhi signed a long-term variable lease for a 260-room mid-scale hotel in the heart of Hyderabad's financial district, right beside its existing Sheraton and Fairfield hotels. And under this model, the developer builds the shell and Samhi only invests in fit-outs, minimizing the upfront capital. The CEO called it the perfect capex to revenue cycle. Basically, a repeatable asset-light model the company now wants to replicate. Analysts also noticed a clear shift towards premium brands, upscale and upscale hotels. Now it accounts for around 60% of revenues, up from 42% years ago. Akanwala explained that it's not about abandoning the mid-scale segment but covering every key commercial hub at different price points. He cited the Holiday Inn Express in Hyderabad, still one of the company's highest ROCE assets, as proof that the mid-scale business remains lucrative when done efficiently. On travel demand, the management team acknowledged a tough first half, disrupted by geopolitical issues, an aircraft accident in Ahmedabad, and heavy monsoons. But starting mid September, trends have rebounded sharply. Jacanwala said, any week that's been free of disruption has seen record run rates. Supply in key markets like Hyderabad, Bengaluru, and Delhi remains tight while demand keeps rising. That means Samhi's RevPAR guidance of 9 to 11% CAGR still holds, with upside from improving average room rates, especially in the upscale segment where ARRs grew in the mid teens. So, what were the key takeaways? A few key takeaways stood out from the analyst interactions as well. Let's look at one by one. First one, funding. Both new projects are self financed from cash flows, not new debt. And on Navi Mumbai, management views it as a once in a decade opportunity with land cost advantage and long term demand certainty tied to the airport. On leases, they expect more variable lease deals, lower capital per key, faster paybacks. On interest costs, refinancing at 7.9% is already locked in, which should pull average borrowing costs below 8% by FY27. And on market discipline, Samhi said it will stay focused on tier 1 office markets, no expansion into secondary cities or greenfield land buys. So, what's the big picture? And what makes this quarter special isn't just profit growth, it's the shift from debt fueled expansion to self sustaining growth. Samhi's free cash flow, balance sheet flexibility, and disciplined reinvestment gives it a credible runway to scale beyond 6,000 rooms by FY27. And if executed well, Navi Mumbai and Hyderabad could together define the next decade of Samhi story, much like Gurugram did for NCR hotels 15 years ago. So, in closing, while the headlines will quote PAT up 691%, the real AlphaCall takeaway is this. Samhi has matured from a leveraged asset owner into a capital efficient compounder. And the next few years will show whether this new discipline can coexist with its growth DNA. But if the current momentum continues, Samhi 2.0 could well become India's benchmark for institutional scale hospitality investing. That's all in today's Alpha Call. Until next time. And as a friendly reminder, this is not investment advice.